Hey guys, what's going on? Welcome back to the channel. We're doing a stock evaluation today on WWE. So let's just jump into the stock right here. We got it in the stock research tool here. We're going to definitely do a value investing approach on this company. We're going to look at the fundamentals. So got it pulled up over here. You know what? I decided to do this company because this past weekend was my brother's birthday, and we went actually to a Road to WrestleMania event where we watched a few wrestling matches, and it was actually entertaining. I've never seen it live. So right now in the stock research tool, we got it on the company metrics. And what we're going to do here, folks, is we're going to look at the 5-year averages and compare them to the trailing 12 months to try to gauge where this company's been standing the last 5 years or so and gauge where it's predicted to go. So what I like to just scan here is any changes in the PE, which I see here we're dropped from 52 over to 25. That's great. Our EPS is higher than our 5-year average. Also phenomenal. Return on equity is also higher than our 5-year average, which is great. Profit margin compared to our 5-year is also up. So right off the bat, first 4 categories, we're doing really well. It's a $4 billion business. That's very interesting. I thought it would be a lot more. So let's jump into the revenue here. We're sitting at $1 billion in revenue. Net income's at 180 million with free cash flow at 139, and our average free cash flow is 142. So a slight dip in free cash flow. I'm actually surprised that these numbers are actually somewhat low, like low profit margins, I guess, for such a huge entertainment business, because they are literally everywhere. If you've watched any WWE, I mean, they got Mondays and Fridays. They fill stadiums, and I was just on the event on Saturday, which is in Kitchener, Ontario. If you know where that is, awesome. But they filled up that arena as well, and they're just racking in all kinds of people, which I'm surprised that's what their free cash flow numbers are. Anyways, we pay a very small dividend, a 0.79%. It's a baby dividend, and that pays out $36 million, which could easily be covered by a free cash flow, because that's one thing you want to keep in mind, folks. If a company pays a dividend, you want to make sure that the company has enough free cash flow on hand to actually pay out that dividend. If they don't, then that can, run into some trouble, because there's some companies that just upkeep a dividend because people are invested for that, and you don't want to be one of those people. A dividend is a bonus. You don't want to just buy companies just for the sake of buying a dividend, because or else you're going to it's just red flags. Either way, they can pay it, no problem. Return on invested capital, phenomenal numbers here, 32% and 25%. Amazing. So we're up on our 5-year average. Allman Z-score 5.179, and Piotrowski score is sitting at 6. Okay, so our Allman Z-score is phenomenal. We want this over 3, and we have that. Piotrowski score is at 6. It is a mediocre score, folks. If you know me, you know I want this number to be between 7 and 9. 9 is our highest score that we could possibly get. 7's all right. 8's solid. 6 is kind of in that middle category, so it doesn't really wow me. This Allman Z score, however, is great, because that means the company is financially healthy and very low risk of going bankrupt. So with the company metrics out of the way, I gotta say right off the top, I'm liking WWE. They've made a lot of improvements over the 5-year averages. So let's jump into our financial evaluations category to see where this company ranks overall. So jumping into here, and I don't know why it does that. It always just takes a second just to load the other window. Maybe I'll just put it like that. So we're sitting at 8 out of 10. That's a really good score. And let's go through those numbers right now. So where it's going to lose points from me is in the 5-year PE average and the debt to equity ratio, which is, I'm not liking that debt to equity ratio. But let's go through these numbers right now in these categories to see what we got. So our 5-year PE ratio is at 52. We want this to be underneath 22.5. So we don't have that, so it's going to get a 0. Where it's going to get points is our current ratio. We want this to be over 1.5, folks, and we have that ever so slightly, sitting at 1.52. Return on equity, our average is 30.72, and it's up in the trailing 12 months, which is phenomenal, but we want this number to be over 15, and we have that, double that actually. EPS growth, we've seen that there's been some growth over the last 5 years from 1.35 to 2.35, so huge points there. Now debt to equity, now here's the problem, folks, and this is where that this kind of shakes me up just a little bit. We're sitting at 105%. We want this number to be under 50%. The reason we want that number to be underneath 50% is because that means that the business is leveraging capital through equity. So they're growing through equity within the business and not taking on debt. In the case of WWE here, we're taking on more debt than equity. So we don't want that. However, on the right side here of our financial evaluations category, it's all green with share dilution at negative 1.6%. So that means they are not diluting you. They're actually buying back shares, which is great, and increasing your ownership, which is what you want. Our net income is growing. Our 5-year free cash flow is growing, and our revenue is growing at 8% with revenue, huge percent over the 5-year free cash flow, and same with our net income. And our return on invested capital sitting at 25.21%. Guys, we want this return on invested capital average sitting at 10% or higher. Sitting at 25 is phenomenal because that's double what we want, and that means they make a really good return on the money they're investing, which is phenomenal. So overall, I'm very, very impressed with WWE. So financially speaking, like it's a pretty solid company so far. And granted, like we've had a huge drop over the last few years, hitting like $90 a share, and then afterwards just decreasing. Yeah, the only main thing that's concerning me right now is this debt to equity and this 5-year PE average. But our PE right now is sitting at 25.74, slightly out of our realm of where we want it. However, it is what it is. Hopefully that doesn't put us in the little overpriced category, but we'll figure that one out once we jump into a price analysis. Before we jump into a price analysis, if you're liking the video so far, make sure you hit that like button and subscribe button. It can be found right here, and I'll stop stuttering. Here's a price analysis. We're going to jump into 3 different evaluations here: conservative, moderate, and aggressive. And we'll put it at 10 years. We'll leave it at 10 years. That's my favorite number because I think WWE is going to be here for a long time, and it's getting busier, bigger. Also, check out Ringside merch on Etsy. That is my brother's store. He does like all homemade wrestling t-shirts. So if you have a wrestling fan, definitely check him out, because you might find something that you would like, or someone in your family might like one of his shirts that he's got up there. There's just a little plug for you there. I'll put a link in the description below. So we're sitting at 8.6. I think I'm going to go a little bit obviously, you know me, I'm going to go conservative to go 7.5 and then 8. Number that I know we could potentially hit over the next 10 years or so. Profit margin, I'm going to put them at 6, 8, and then 10. Free cash flow margin, we're going to go 8, 12, 14. Maybe I'll do 10. I'll do 10, something in the middle. And then price to free cash flow, I'm going to go 12, 16, 18. Making that, actually, you know what? We'll do 13.5. How about that? And then we'll do PE ratio. We'll go 12, 14, and 16. And then desired return, we always like to do lucky number 13. So we're slightly overvalued here, folks. Current price is $61. Our average calculation comes out to be $28. And I mean, listen, that kind of makes sense. Look, you get the PE, right? And then you cut it in half from 25. Maybe just, okay. Cut that PE in half from, let's say, 25 to, let's say, 12 or so. It makes sense, right? You're going from 60 almost to $30 a share ish, right? From 14, if you're going to 14 PE ratio. Yeah, that makes sense. Here's the thing with this business. Do I think they can maintain these profit margins? If so, from the last 1 year and 5 year, if so, then this should somewhat hover around 9, 10, and maybe 10.5, which puts our average calculation at about around still in that 30 range. So essentially, this price needs to just fall in half of what it seems like that needs to happen. So my thoughts on WWE are simply this. I believe the company is overvalued, and the reasons are somewhat justified. You got a high debt to equity ratio, so they're taking on all this debt to grow this business, and the business is growing extremely slow. And 8% revenue growth over the last 5 years is it's pretty, it's pretty bad. It's pretty bad with low profit margins, low net income, and low free cash flow. This is a it's a slow growing business. There's a lot of, like, granted, there's a lot of positive metrics that are happening. Like, it's good that the company is growing. However, you're overpaying for that growth. They're not diluting you in shares, which is phenomenal. However, paying what it's currently priced at right now at the time of recording this video is at $61. It just doesn't make sense at all, because you're getting this slow growing business. It's a $4 billion company, and you're getting growth numbers similar to what Intel's doing, and Intel's like a $200 billion company. Just to put into perspective, right? You have a $200 billion company that's not diluting you also. So in order for WWE to make sense in my books, for it to at least be in that buy range, you'd have to go, and the price needs to just simply just drop in half. That's it. I mean, honestly, even be 1/3 of the price. I would take it at 25, 22, 25, somewhere within that range. To me, that would make sense to try to justify these low growth numbers. If by chance, miraculously, it starts growing at record paces like this revenue growth here at 12%, yeah, if it was, listen, it'd be probably a buy all day if it can upkeep those numbers. But you have to be super conservative, folks, with these numbers, because look, 8 and 9, yeah, that could potentially happen. But as a company gets larger and larger, you have to assume slower growth rates. And where this company's standing right now, at a $4 billion evaluation with the slow growth rates that it has, it doesn't make sense to me. So yeah, guys, that's the video. Make sure you do your own due diligence. Remember, this is all entertainment. It's not financial advice. If you're looking to find this software that you see in front of me, if this is something that interests you, send me an email. My email will be found in the description below. It's also on my channel page. That's the video, guys. Yeah, keep doing suplexes and whatnot. That's the gist. See you in the next video, guys. Thank you so much for watching.